Today on Real Estate Backstage, NAR announces changes to its clear cooperation policy. Rocket announces an acquisition of Mr. Cooper. The Federal Reserve decides to hold rates steady. HUD announces it will begin requiring proof of permanent resident status for all FHA loans. And of course, we have the sweeping new tariff policy announced by Donald Trump, which sent markets tumbling. Now, before we jump in, and we've got a lot to get to today, but before we jump in, if you're watching this on YouTube or if you're listening on Apple Podcasts or Spotify, make sure to subscribe to the show. That way you don't miss any future episodes. And if you're looking for the show notes with links to all of the articles we're going to reference today, you can find that at realestatebackstage.com/episode 23. Now, if this is your first time watching or listening, I'm your host. I'm Michael Smith. I'm the CEO and broker in charge here at Bluefield Realty Group. We're a 3-time Inc. 5000 company headquartered here in Greenville, South Carolina. And we offer real estate brokerage, property management, and insurance services. All right, so we are going to jump right in. We're going to start with this new law passed by Alabama that seems to contradict the NAR settlement. So this is according to RIS Media. Quote, back in November, as a judge considered final approval of the National Association of Realtors landmark settlement agreement, NAR attorney Ethan Glass warned of the possibility that realtors could be put in a position where complying with the terms of that deal could conflict with other laws. That has proved prescient as earlier this week, Alabama Governor Kay Ivey signed a bill that explicitly bans any requirement for buyer agreements before agents tour properties with a client. Notably, the bill was shepherded through the legislature by the Alabama Realtors, which has previously criticized NAR and highlighted legal threats to the industry. With the new law in place, potential buyers cannot be forced to sign a binding agreement just to view a property. Instead, a written agreement is required prior to submitting an offer, ensuring greater transparency and consistency in real estate transactions statewide, the association wrote on Facebook. In response to an emailed inquiry, Alabama Realtors CEO Jeremy Walker emphasized the law was supported by members and that they had a voice for the first time in this process through a democratically elected body. State associations have a First Amendment right to organize, engage in the political process, and pursue legislation that benefits their members and consumers. And importantly, state legislatures are the appropriate body to govern laws affecting real estate matters, Walker wrote. We are excited that the new law will provide greater transparency for consumers in their first interaction with an agent in the home buying process and allow them the opportunity to build a relationship with an agent before entering into a buyer's agreement. Walker did not respond to a specific question regarding what kind of guidance Alabama Realtors was providing to members in relation to the law and the settlement, or whether he had been in contact with NAR. A NAR spokesperson deferred specific questions regarding to Alabama Realtors, but pointed to previously released guidance saying that state law takes precedence over the settlement. Written buyer agreements will be required of all MLS participants working with buyers prior to touring a home, unless state law requires a written buyer agreement earlier in time, the guidance also reads. But it remains unclear exactly how direct conflicts between a state law and the legally binding settlement agreement will play out. Now, I need to interject here. The settlement is actually very clear in this. It does specifically say in that section, talking about the requirement to have a written agreement in place before touring homes when you're working with a buyer. It does specifically say unless contrary to law. So if there is a law in the state of Alabama or any other state that says you cannot force a buyer to sign a written agreement before touring a home, then the settlement is very clear that that law would supersede the settlement agreement. Back to the article. Other states have taken very different approaches, with Ohio passing a bill last summer to directly align state law with the NAR settlement by requiring buyer agreements before buyers can tour a property. More proposed bills have challenged the NAR policy changes in other ways, including a proposed bill in Oklahoma, which would explicitly allow agents or brokers to compensate each other, unquote. All right, so this is according to Inman. NAR has announced some changes to the clear cooperation policy. We've been following the story for several months now. This is according to Inman. Quote, the National Association of Realtors on Tuesday announced it would keep its divisive clear cooperation policy while rolling out an exemption to the rule, ending months of speculation on the changes and their impact on brokerages. The multiple listing options for sellers policy introduces a new category of listings called delayed marketing exempt listings, NAR announced. The MLOS policy took effect on Tuesday and must be implemented by September 30th, NAR said. The new exemption would allow sellers to have their listing agent delay putting a listing on the Internet Data Exchange, or IDX, for a set period of time that would be determined by each multiple listing service. The new policy does not change an MLS's local mandatory submission deadlines, or CCP, and its requirement to file a listing with the MLS within 1 business day from public marketing, NAR said. NAR board members first approved the clear cooperation policy in 2019. The rule required realtors to submit their listings to NAR-affiliated multiple listing services within 24 hours of when they began marketing those listings. Critics of the rule, including high-profile figures such as Mauricio Umansky and Gary Gold, were vocal from the beginning. But proponents argued that, among other things, getting rid of pocket listings would cut down on discrimination. The news followed months of wrangling and positioning by brokerages that had strongly opposing views on what to do with CCP, which requires agents to put a listing on the MLS within 1 business day of marketing the property. NAR made clear on Tuesday that CCP had not been changed and remains in effect. With the creation of the new policy, NAR will leave it up to hundreds of MLSs across the country on how to determine how long agents can delay marketing a property. NAR is also clarifying its policy interpretation that one-to-one broker-to-broker communications about listings do not trigger CCP requirements, NAR wrote. However, multi-brokerage communications about a listing will constitute public marketing under CCP. Agents must obtain a signed disclosure document showing the seller's intent to waive the benefit of immediate public marketing through IDX and syndication, NAR wrote in an FAQ released on Tuesday. That disclosure is required for both delayed marketing and for office-exclusive exempt listings, NAR said. NAR said it wasn't setting a nationwide delayed marketing period because MLSs were better positioned to determine that time frame. Those MLSs would also determine whether the number of days a seller delays marketing the property under the MLOS policy counts toward total days on market. NAR also noted that other MLS subscribers would have access to the delayed properties. A delayed market exempt listing will still be available to other MLS participants and subscribers through the MLS platform so they can inform their consumers about the property, NAR said, unquote. All right, so let's unpack this a little bit. So the clear cooperation policy states that if you take a listing and you begin any type of public marketing, so marketing outside of your brokerage, then you have to submit that listing to a NAR-affiliated MLS within 1 business day. And there would be a certain period of time, maybe it's 5 days, 7 days, 100 days. Each local MLS could decide this for themselves. A period of time where it is active in the MLS for other members to see and share with their clients, but the listing is not syndicated out through IDX feed to third-party websites, Zillow, Realtor.com, etc. So this is an interesting exemption. I think it's a step in the right direction. It creates a little bit more flexibility. There are certainly a lot of people who are going to feel like this doesn't go far enough of giving the seller the flexibility and the choice and really the ability to be in the driver's seat of how, when, and where their property is marketed. So this is going to be particularly confusing for people like us who are members of multiple different MLSs, depending on how big of a territory you work. It can create some confusion as to, well, which MLS am I going to submit it to so that I have more time to do this marketing publicly without having the syndication. So this is an interesting story. We're going to continue to follow it as it develops. So last episode, we talked about Rocket's acquisition of Redfin, and I wanted to kind of circle back around and revisit that real quick. I read an article from Mike Del Prete that was really interesting. I want to share some of it with you guys. So again, this is according to Mike Del Prete. Quote, with its acquisition of Rocket, Redfin's saga as an independent company is coming to a close. Launched in 2002, Redfin could be considered the original real estate disruptor, featuring discounted commissions, employed agents, and innovative technology. But the business model just never clicked. Redfin was rarely profitable, accumulated a large debt load, and was acquired for the same value as when it went public over 7 years ago. After its first day of trading as a public company in 2017, Redfin was valued at $1.73 billion, just shy of its acquisition price of $1.75 billion 7 years later. After Redfin's first day of trading in 2017, each share was valued at $21.72, significantly higher than Rocket's acquisition offer of $12.50 per share. If you owned $100 of Redfin shares in 2017, they would be worth $58 today, a decline of 42% due to dilution. Since its IPO, Redfin had 2 profitable years versus 5 unprofitable ones, for a combined loss of $368 million. Again, this is actual cash flow and not net loss, which includes non-cash expenses like stock-based compensation. Redfin innovated in so many areas, from agent compensation to groundbreaking tech products, but at the end of the day, it just didn't make money. Not only is Redfin consistently unprofitable, but it has a high debt load of $815 million, with steadily dwindling cash reserves of just $125 million at the end of 2024. Much of that debt, totaling over $1.2 billion by the end of 2021, was used to fund a pair of expensive acquisitions. Redfin acquired RentPath for $608 million in 2021 and Bay Equity Home Loans for $138 million in 2022. It's fair to say that the acquisitions didn't pan out as expected. Redfin recently announced a deal that effectively outsourced its rental business to Zillow for $100 million. And in contrast to Zillow's growing mortgage business, Redfin had to cut costs. Its mortgage headcount declined from over 450 mortgage loan officers in 2023 down to 275 in March of 2025. Redfin tried to do a lot: web portal, brokerage, iBuying, mortgage, rentals, title insurance, and more. In the end, it might be the lack of disciplined focus that prevented Redfin's success, unquote. So I thought this was a really well put together article from Mike Delpreet about the Redfin experiment. Again, the valuation that Rocket paid to acquire Redfin, $1.75 billion, is about the same of the market cap back 7 years ago when it originally went public. And in fact, if you had invested in Redfin during the IPO, you actually lost quite a bit of money due to the dilution of your shares through additional funds raising. So Redfin tried to do a whole lot of different things. From the outside looking in, it appears they really weren't able to figure out how to do anything well consistently, and certainly not profitably. So again, kind of an interesting case study in a company that tried to be very innovative and ended up not really working out. So speaking of Rocket, we have more news this week. Rocket has announced that it is acquiring Mr. Cooper, which is the largest mortgage loan servicing company in the country. This is according to Inman. Quote, in a massive deal between two of the biggest names in the mortgage business, Rocket Companies is set to acquire Mr. Cooper, Inc. in an all-stock deal for $9.4 billion in equity, the companies announced on Monday. Rocket is one of the largest lenders in the U.S., second by originations, according to the latest data available from 2023. And Mr. Cooper is the largest mortgage servicer in the country. This move comes just a few weeks after Rocket announced that it would be acquiring Redfin for $1.75 billion in equity. The combined company will service more than $2.1 trillion in loan volume across about 10 million clients, which is equal to about 1 in every 6 mortgages across the nation, a press release stated. Servicing is a critical pillar of homeownership, alongside home search and mortgage originations, Varun Krishna, CEO of Rocket, said in a statement. With the right data and AI infrastructure, we will deliver the right products at the right time. That's how we build lifelong relationships, by proactively unlocking benefits and meeting needs before they arise. We look forward to welcoming Mr. Cooper's nearly 7 million clients. Rocket Mortgage currently has an 83% recapture rate, and with a larger servicing portfolio through the acquisition, the company expects to at least hold steady. In gaining about 7 million new clients through the acquisition, the company will also grow its data set, which it believes will allow it to improve automation, personalization, and efficiency across processes. When the deal is closed, Mr. Cooper Group Chairman and CEO Jay Bray will become President and CEO of Rocket Mortgage and report to Krishna. Dan Gilbert will continue to serve as Chairman of Rocket Companies. The combined company's board will include 11 members, 9 of whom will be from Rocket's board, and 2 of whom will be from Mr. Cooper's board. With the acquisition, Mr. Cooper shareholders will receive a fixed exchange rate of 11 Rocket shares for each share of Mr. Cooper common stock, a press release explained. Based on the closing price as of March 28, 2025, each share will represent $143.33, which is a premium of 35% over the volume-weighted average price of Mr. Cooper's common stock for the 30 days ending on March 28th. Once the transaction is closed, Rocket shareholders will own about 75% of the combined company, and Mr. Cooper shareholders will own about 25%, unquote. So it looks like Rocket is wanting to take over the world. Lots of acquisitions here recently, and they seem to be throwing around billions of dollars. So a lot of people seem to be worried about Zillow and other companies taking over the real estate industry, but Rocket seems to be the most well-positioned to really create this end-to-end platform that everyone's been dreaming about for the past several decades. Zillow talks a lot about their super app, and they've done all these ancillary businesses like mortgage and title, et cetera. If anyone can do it, it looks like Rocket might be the one to do it. Everyone says their company is not for sale, but as long as Rocket is throwing billions of dollars around, hey guys, if you're listening, Bluefield Realty Group here in Greenville, South Carolina, give me a call. I'd love to chat. Just kidding. Sort of. Everyone's got a price. All right, shifting gears, let's talk about the Federal Reserve. So this is according to Connect CRE. The Federal Reserve underscored a sharp rise in uncertainty regarding the economic outlook, even as it maintained an optimistic tone about current conditions. The March FOMC statement noted that economic activity was still growing at a solid pace and that the unemployment rate had stabilized at a low level. However, the Fed acknowledged that inflation remained somewhat elevated. What stands out in the latest summary of economic projections is the surge in uncertainty surrounding the forecast for growth, unemployment, and inflation. Compared to the December 2024 update, the current outlook reflects a broader range of potential outcomes that the Fed must now account for. While the FOMC decided to hold rates steady, officials lowered their growth forecast for real gross domestic product to 1.7%, down from the previous estimate of 2.1%. Meanwhile, it raised its projection for core personal consumption expenditures, PCE, inflation to 2.8%, up from 2.5%, and increased its unemployment forecast to 4.4% from 4.3%. The Fed's decision to hold rates steady came as no surprise. While most investors are continuing to underwrite a soft landing from a macro standpoint, we all have our eyes trained on the potential inflationary impact of heightened tariffs, especially as it relates to the cost and availability of building materials. Marion Jones, Principal Executive Managing Director of U.S. Capital Markets at Avison Young, shared with Connect. Federal Chair Jerome Powell addressed the challenge of disentangling the sources of inflation, particularly in relation to President Trump's aggressive tariff policies. Powell admitted that pinpointing how much inflation stems from tariffs is complex, stating clearly some of it is attributable, but emphasized it's premature to determine whether the Fed can simply look through tariff-related price increases. Powell avoided directly mentioning President Trump, but pointed to the upheaval in Washington as a key factor unsettling economic sentiment. We understand that sentiment is quite negative at this time, and that probably has to do with turmoil at the beginning of an administration that's making big changes in policy, he remarked in the press conference. Earlier this year, the U.S. economy showed positive signs with solid hiring and growth, along with declining inflation. However, challenges such as ongoing inflation, tariff threats, and reduced consumer and business confidence have emerged, Michael Underhill, CIO of Capital Innovations, told Connect. These factors raise concerns about stagflation, a troubling mix of stagnant economic growth and high inflation. This scenario is particularly challenging for the Fed, as traditional approaches to managing inflation or unemployment may conflict in such conditions, Underhill added. Despite the heightened uncertainty, most officials still anticipate interest rates will fall by year-end to a range of 3.75 to 4%, consistent with the projections from December 2024. However, views among policymakers diverge notably. 8 of them now predict either no further rate cuts or just a single reduction, while only 2 expect a more significant drop of 0.75 percentage points. We know in the near term to expect some continued volatility in the cost of capital, but the rate cut conversation is giving way to a larger dialogue around trade wars, rising costs, and potential supply chain disruption. This confluence of factors can affect the rebounding office market, where every TI dollar is scrutinized heavily, added Jones. Looking further ahead, most officials expect interest rates to drop an additional 0.5 percentage point by the end of 2026, bringing the federal funds target range to 3.25 to 3.5%. By 2027, most foresee rates settling around 3%. The Fed is likely to remain on hold over the near-term future, given the renewed inflation concerns and what has been until recently a relatively steady pace of economic growth. Brian Jordan, chief strategist at Cycle Framework Insights, told Connect. Looking further ahead, the recent spike in uncertainty and the early signs of knock-on effects in investment, hiring, and consumption should mean a resumption of the easing cycle in the months ahead, said Jordan. The Fed also announced adjustments to its balance sheet strategy. Starting in April, the Fed will reduce the speed of its ongoing reduction of its approximately $6.8 trillion portfolio of Treasury securities and mortgage-backed securities. This shift signals a more gradual approach to unwinding its massive holdings, unquote. All right, so the Fed decided not to reduce rates at this most recent meeting, and that's due to concerns that inflation is not yet solved, the labor market is kind of on unsteady footing, and there's a lot of uncertainty, economic uncertainty about how these tariffs are going to impact both the job market and inflation. Now, the Fed didn't make any change to the federal funds rate at this meeting, but they did signal that they're going to be reducing the rate at which they're unwinding their balance sheet holdings. So there are 2 main tools in the toolbox for the Fed. There are two things that the Fed did to combat inflation, which they started several years ago. Everyone knows that they jacked up rates, the federal funds rate, but what they also did was reverse course on the quantitative easing that they had been doing in the aftermath of the COVID recession to try and keep the economy from slipping into even worse of a position. So quantitative easing is when they purchase Treasury securities, mortgage-backed securities, other bonds on the open market to artificially lower rates. Because when you create extra demand, surplus demand for the bonds, that drives the price of those bonds up. We all know that higher demand leads to higher prices, and there's an inverse relationship between price and yield for bonds. So when they create that artificial demand by buying bonds on the open market, that drives rates down. That's one of the things that they were doing after the COVID recession to try and prop up the economy. Now, when inflation came about a couple years ago, the Fed raised their federal funds rate, but what they also did is they stopped buying bonds on the open market and they started unwinding that position by selling those bonds. Now, selling bonds creates additional supply, which creates downward pressure on prices, which, because of that inverse relationship between price and yield, is something that the Fed can do to also raise rates in the marketplace without actually having to raise the federal funds rate. So those are the two things that the Fed did. They raised the federal funds rate, and they also started this quantitative tightening where they were unloading bonds onto the market to basically artificially reduce the price and drive up the yield. So those are the two things that the Fed did. Now, as of right now, they're keeping rates steady. Again, they have done some reduction from their peak on the federal funds rate, and now they are slowing the rate at which they're unwinding their portfolio, which means there's not going to be as much downward pressure on rates as there has been from the Fed selling their stockpile of Treasury bonds and mortgage-backed securities on the open market. So I hope that makes sense. All right, moving on. Let's talk about Bill Pulte. So he's recently confirmed as the new FHFA director. This is according to RIS Media. Quote, private equity executive Bill Pulte, whose family founded and runs one of the largest home builders in the country, was officially confirmed by the Senate on March 13th to head up the Federal Housing Finance Agency, or FHFA, by a vote of 56 to 43. In separate statements, the National Association of Realtors, National Association of Home Builders, and the Mortgage Bankers Associations congratulated Pulte and emphasized the importance of his role in overseeing the GSEs, Fannie Mae and Freddie Mac, which he is likely to guide toward an end of their long conservatorship. On behalf of the National Association of Realtors, I want to extend our sincere congratulations to Bill Pulte on his confirmation as director of the Federal Housing Finance Agency. His leadership comes at a pivotal time as we face historic housing challenges, including affordability concerns and a nationwide housing shortage. Our members stand ready to work with Director Pulte and his team, Fannie Mae and Freddie Mac staff, the federal home loan banks, and other industry stakeholders, wrote NBA President and CEO Bob Brooksmith in a statement, to increase affordable and sustainable homeownership and rental housing opportunities for all Americans while ensuring a robust secondary mortgage market for single-family and multifamily lenders of all sizes and business models. We stand ready to work with Director Pulte to help address the nation's housing affordability crisis by promoting policies that ensure stable and liquid mortgage markets for single-family and multifamily housing, said Buddy Hughes, NAHB chair. Providing builders and homebuyers better access to financing will enable home builders to boost the supply of attainable, affordable housing to meet the market demand and keep the economy strong. Pulte, whose grandfather founded the mega home builder that bears his name, Pulte Group, has worked in private equity, including in sectors close to housing, and is a longtime Republican donor. His nomination was widely supported in the housing industry. FHFA oversees a housing finance system that is uniquely American, but whose reform is long delayed, McGann continued. It is of the utmost importance that we take a measured and thoughtful approach to any GSE reforms. We are confident that Director Pulte's experience and commitment will help strengthen the housing finance system and support sustainable homeownership for all Americans. We look forward to working with him to ensure a stable, accessible, and thriving housing market for generations to come, unquote. So shortly after stepping into his new role, Pulte is already shaking things up. So this is according to RIS Media. Quote, several of Freddie Mac's top officials, including CEO Diana Reid, were fired yesterday by new FHFA Director Bill Pulte. President Michael Hutchins is to act as interim CEO. A longtime leader in the banking industry, Reed was hired to lead Freddie in September of 2024, having previously led the real estate division of PNC Financial Services Group. Hutchins previously served as an interim CEO before Reed was hired, having been named president of the organization in 2020. It was previously reported on Monday that Pulte had removed 8 members from the Fannie Mae board and introduced 4 new ones, including himself. He also removed 6 members from the board of Freddie, adding 4 new members, including himself. FHFA General Counsel Clinton Jones was also added to Fannie's board. 2 separate filings with the Securities and Exchange Commission confirmed that Pulte is now serving as chairman of both the Fannie and Freddie board. The Trump administration and Pulte have both expressed the sentiment of privatizing the GSEs, Fannie and Freddie. It is unclear whether these leadership changes relate to this plan or not, unquote. So when they say privatizing the GSEs, they really mean reprivatizing, because even though Fannie and Freddie were originally chartered by Congress, they were operated as independent corporations for a very long time, until, of course, they had to be put into conservatorship during the 2008 financial crisis. Now, any effort to reprivatize Fannie and Freddie need to be done very, very cautiously. There's a reason they were put into conservatorship in the first place. Yes, they have been profitable and they have been rebuilding their cash reserves, their net worth, but we just need to be very, very careful. Markets are so finicky. We need very strong, we need strong liquidity. We need a very strong secondary mortgage market. Fannie and Freddie have played a very pivotal role of helping the United States housing market be as resilient as it is, and we certainly don't want that to change. All right, meanwhile, HUD has announced that it will begin requiring proof of permanent residency status for all FHA loans. And this is according to RIS Media. Quote, the U.S. Department of Housing and Urban Development announced on Wednesday it will no longer allow non-permanent residents or non-U.S. citizens to obtain FHA-insured mortgages. This significant policy shift aligns with the Trump administration's tougher stance on illegal immigration. The changes, published in Mortgagee Letter 2025-09 and Title I Letter 490, take effect May 25th and remove eligibility for non-permanent resident aliens who previously qualified with valid Social Security numbers and work authorization documents. Under the new guidelines, only U.S. citizens, lawful permanent residents with green cards, and citizens from the Federated States of Micronesia, the Republic of the Marshall Islands, or the Republic of Palau will be eligible for FHA-insured financing. This includes FHA loans and home equity conversion mortgages, HECMs, or FHA-insured reverse mortgages for senior homeowners. The letters cite concerns about non-permanent residents' ability to repay their loans over the long term due to the uncertainty of their residency status. Currently, non-permanent residents are subject to immigration laws that can affect their ability to remain legally in the country, the letters note. This uncertainty poses a challenge for FHA, as the ability to fulfill long-term financial obligations depends on stable residency and employment. The change follows President Donald Trump's executive orders prioritizing government resources for American citizens, part of his broader crackdown on illegal immigration since returning to office in January. In a series of posts on X on Wednesday, HUD Secretary Scott Turner doubled down on the new policy. Today, HUD terminated Biden's taxpayer-backed FHA mortgages for illegal aliens. American taxpayers will no longer subsidize open borders by offering home loans to those who enter our nation illegally, Turner wrote. HUD is prioritizing Americans, not illegal aliens. POTUS promised to end taxpayer subsidies for illegals, and today we put an end to illegals receiving FHA home loans. HUD-backed mortgages should benefit Americans who play by the rules and work hard, not those who enter our country illegally. For mortgage lenders and applicants, the new guidelines emphasize that a Social Security card alone is insufficient to prove immigration status. Evidence of lawful permanent residence must be documented with additional verification from U.S. Citizenship and Immigration Services. HUD's change represents one of the most significant restrictions on FHA lending criteria in recent years and is likely to force non-permanent residents to seek conventional financing options. These loans typically require larger down payments and higher credit scores and are generally harder to qualify for than government-backed loans, unquote. I had a conversation a few days ago, actually, with an agent who was really concerned about this. She was thinking that the removal of the ability to give these FHA loans to people without permanent resident status was going to tank the housing market. Now, HUD doesn't track exactly what percentage of loans were being made to individuals that fall in this category, but I've seen some estimates that it's probably less than 1% of all FHA loans goes to people without permanent residency status. So while this, of course, will make it difficult more difficult for certain people to buy homes, it should not have a tremendous impact on the overall market. All right, let's shift gears real quickly and touch on consumer confidence. So this is according to Inman. Quote, the Trump administration's plan to bring jobs back to the U.S. by imposing tariffs on imported goods has a growing number of Americans worried that soon they'll not only be paying higher prices, but also could end up unemployed, according to a closely watched survey of consumers released on Friday. The University of Michigan surveys of consumers for March showed Americans expect inflation to surge to 4.9% in the year ahead, the highest reading since 2022, and that the net balance of households who expect unemployment to increase is at levels not seen since the Great Recession of 2007 through 2009. Although the survey showed that Republicans are less worried about inflation and unemployment than Democrats and independents, consumers from all three political affiliations are in agreement that the outlook has weakened since February. Surveys of Consumers Director Joanne Su said. At 57.9 in March, the University of Michigan Index of Consumer Sentiment has fallen for 3 consecutive months, dropping 10.5% from February to March and 22% from December. While current economic conditions were little changed, expectations for the future deteriorated across multiple facets of the economy, including personal finances, labor markets, inflation, business conditions, and stock markets, Su said in a statement. Many consumers cited the high level of uncertainty around policy and other economic factors. Frequent gyrations in economic policies make it very difficult for consumers to plan for the future, regardless of one's policy preferences, unquote. So we've got consumer confidence on the decline, and we've also got some bad news here for builder confidence as well. Now, this is according to RIS Media. Quote, home builder confidence came in at 39, and that's out of 100, in March, its lowest reading in 7 months, as recorded by the latest Housing Market Index, HMI, reported by the National Association of Home Builders and Wells Fargo. As measured by the index, current sales conditions for single-family homes fell 3 points month over month to 43. Traffic from prospective buyers also dropped from 29 to 24. However, sales expectations for the next 6 months stood unchanged at 47. Close to one-third, 29%, of home builders cut prices in March compared to 26% in February. However, the average price reduction of 5% was unchanged month over month. NAHB's press release says that despite builder optimism about the cutting of regulations, economic uncertainty has caused many builders to take a more cynical outlook. NAHB Chairman Buddy Hughes and Chief Economist Robert Dietz both attributed the drop in confidence to high cost pressure from tariffs, unquote. All right, so speaking of tariffs, we're going to wrap things up today by really dissecting Trump's tariff policy. So here we are, Liberation Day. On Wednesday, April 2nd, Donald Trump announced his new broad, sweeping tariff regime. He called it Liberation Day, claiming that these policies will liberate the United States from the economic oppression that other countries have been exerting on us in the form of unfair trade practices. Now, he's calling it Liberation Day. Other people are calling it Recession Day, predicting that this will put us on the path to the next economic downturn. So this is according to the Wall Street Journal. Quote, U.S. markets suffered their steepest decline since 2020 as investors grappled with the threat that President Trump's new tariff plan will trigger global retaliation and hurt the economy. Major stock indexes dropped as much as 6% on Thursday. Stocks lost roughly $3.1 trillion in market value, their largest one-day decline since March of 2020. Stock index futures continue to drift lower Thursday evening. The Dow Industrials dropped 1,679 points, or 4%. The tech-heavy NASDAQ, which powered the market higher for years, was down 6%, pulled lower by big declines in NVIDIA, Apple, and Amazon. The S&P 500 fell 4.8%, and the other benchmarks suffered their sharpest declines since the early days of the COVID-19 pandemic. The dollar, meanwhile, tumbled, with the WSJ Dollar Index suffering its sharpest decline since 2023. The 1.3% fall brought the greenback to its lowest level since October, a sign of unease over the growth outlook and fears that the flow of funds into the country will be sharply curtailed. The dollar sank more than 1% against the euro, the Japanese yen, and the Swiss franc. Some of America's allies came out swinging after the details of the U.S. president's tariff plans were disclosed late Wednesday. French President Emmanuel Macron said Europe is weighing retaliation against the United States tech firms, while Canadian Prime Minister Mark Carney said his country will match President Trump's auto tariffs with 25% tariffs of its own. Trump took the sell-off in stride. I think it's going very well, Trump said in response to a question about his tariffs Thursday afternoon. The markets are going to boom. Later Thursday, he left the door open to making deals to lower tariffs while also promising new ones on pharmaceuticals and semiconductors. Dozens of household name stocks posted double-digit declines, including HP, Nike, and Target. Stellantis also fell sharply. The Jeep maker said it is temporarily halting production at its auto assembly factories in Mexico and Canada. The turmoil spread beyond stocks, with oil prices dropping more than 6% and investors selling gold after its sharp run over the past year to fresh records. Inflation expectations rose, but so did fears that the tariff will tip the economy toward recession, sending investors to the safety of treasuries. So far, traders said, selling has been orderly, and though the scale of the U.S. tariffs came as a shock, few investors are surprised to see stocks pull back following their gains over the past 2 years. Still, the decline sets up financial markets for one of their most precarious periods in recent years, as the tariffs and international reaction test that faith of investors used to sticking with stocks, unquote. So the silver lining here, if you want to find one, is that mortgage rates took a tumble on Thursday, and that's because whenever there's negative economic news or the perception of negative things happening in the economy and investors sell off their stocks, causing stock prices to go down, they tend to shift that money into things that they deem to be safer, like treasuries, other bonds, mortgage-backed securities. That extra demand for bonds pushes bond prices up, which in turn brings the yields down. So again, if you want to find some optimism, some silver lining here, is that even though the stock market had a very bad day, we did see mortgage rates come down. So if you're currently under contract to buy a house, may have been a good time to lock in that mortgage rate. Now, I think the fact that we saw such a bad day in the stock market is not too big of a surprise. In reality, I think the stock market has been overvalued for the last several years. PE ratios are way out of whack, way higher than historical averages. So I think any type of shock to the system, it's kind of like a house of cards. I think the fact that stock prices were so high, PE ratios were so high, anything could have sent, kind of a domino effect to send stocks tanking downwards. But again, he gave us warning. Trump talked a month ago about how his, big reciprocal tariff plan was going to come out on April 2nd. I think that people just didn't realize how extensive the tariff regime was going to be. So Trump went out to the Rose Garden for his press conference. He had this big sign with a list of the tariff rates that each country was charging us, allegedly. We'll get to that. And the reciprocal tariff rates that we're going to be placing on goods imported from those other countries. And supposedly the rate that we're charging them is actually half of what they're charging us. Originally, Trump had talked about reciprocal tariffs. Whatever you charge us, we're going to charge you. He said, hey, we're going to be kind. We're only going to charge you half of what you're charging us. Now, here's the problem. The numbers that Trump provided just simply weren't accurate. I'm going to put up a graphic here on the screen. This is from the little sign, the big sign that Trump was holding up in the Rose Garden. And in the first column there, you see the name of the country. The middle column is supposedly the tariff rate that they're charging us. And then that final column in yellow is what we are going to impose on imports from that country. The only problem is that these are not actually the tariff rates. So according to this chart, China is charging a 67% average tariff rate on goods that it imports from the United States. According to this chart, South Korea charges us a 50% tariff rate. Thailand charges us 72%. South Africa allegedly charging us 60%. Israel charging us 33%. However, Trump referred to these as the tariff rates. These are not the tariff rates. And we'll get to that in more detail. So according to the Wall Street Journal, quote, the new U.S. tariffs that are rattling markets and promising globe-spanning trade barriers reflect a fixation of President Trump's. The difference between how much stuff the U.S. buys from and sells to each of its trading partners. The White House laid out new tariffs on more than 200 countries in two main ways. For more than half, it imposed a flat reciprocal tariff of 10%. For the rest, it added an additional levy based on a basic formula. In these instances, the Trump administration determined costs it said that countries imposed by taking the amount of a nation's 2024 goods trade imbalance with the U.S., then dividing that by the value of the goods America imported from that nation. A White House handout called these costs a tariff charged to the U.S., including current manipulation and trade barriers. From there, in nearly all cases, the Trump administration imposed new discounted reciprocal tariffs of roughly half that result. Drop your trade barriers and start buying tens of billions of dollars of American goods, Trump said on Wednesday. Several economists said that basing tariffs off of bilateral goods deficits is confusing and illogical. I would agree with that. Goods deficits are a normal feature of a healthy trade and do not imply that anything is wrong. said Gian Maria Malesi Ferretti, a senior fellow at the Brookings Institute. Take a relatively poor country that mostly exports coffee to the U.S., its citizens might lack the wealth to buy the kind of high-value goods, such as Boeing aircraft or Tesla SUVs, that American factories specialize in. But that is no reason to discourage that country's coffee from reaching American consumers, especially because few places in America have the right climate to grow coffee domestically. The U.S. added reciprocal tariffs on several less wealthy coffee exporters, such as Guatemala and Honduras. The White House figures initially confused economists because they didn't seem to correspond with what foreign countries actually charge against imports from the U.S. For example, Chinese tariffs against the U.S. were about 23% overall as of last month. According to the Peterson Institute for International Economics, the White House chart said that China's tariffs and trade barriers were 67%. In response, the White House added new tariffs of 34% atop levies already charged to that country. Data sleuths on social media soon reverse-engineered the formula behind the White House's calculations, zeroing in on the trade-related math, dividing the U.S.'s 2024 goods trade deficit with China, $295 billion, by the amount that the U.S. imported from China resulted in the White House's 67%, unquote. All right, so I've got a chart here I'm going to put up on the screen for those of you watching on YouTube. So this is an example of some of the trade deficits that we have with a handful of countries. So you can see the gold line there is our exports. The peach line there is the imports. So whenever we export less to a country than we import from it, we have a deficit, a trade deficit. Now, Donald Trump loves to believe that this is in and of itself a negative thing. I strongly disagree with that. But whether you agree with it or not, the amount of our trade deficit as a percentage is in no way akin to the tariff rate that that country charges on our goods reaching their shore. So meanwhile, Trump warned automakers not to raise their prices. This is according to the Wall Street Journal. Quote, when President Trump convened CEOs of some of the country's top automakers for a call earlier this month, he issued a warning. They better not raise car prices because of tariffs. Trump told the executives the White House would look unfavorably on such a move, leaving some of them to feel rattled and worried that they would face punishment if they increased prices, people with knowledge of the call said. Instead, Trump said they should be grateful for his elimination of what he called former President Joe Biden's electric vehicle mandate, which involved subsidies and emissions requirements to encourage electric car production. He made a lengthy pitch for how they would actually benefit from tariffs, two people on the call said, adding that he was bringing manufacturing back to the United States and it was better for their industry than previous presidents. On Wednesday, Trump announced a 25% tariff on all imported vehicles and parts, starting April 2nd, a move almost certain to force American car makers to raise prices on customers. Most automakers depend on parts and materials from other countries to make cars, including vehicles assembled in the United States. You're going to see prices going down, but going to go down specifically because they're going to buy what we're doing, incentivizing companies to, and even companies to come into America, he said at the event. Trump's relationship with automakers since taking office has been a rocky one, illustrating one of the challenges so far to his economic orthodoxy. The president is trying to curb inflation. Voters' cost of living concerns helped fuel his 2024 victory and are now one of his top vulnerabilities, experts say. While imposing tariffs on industries such as auto manufacturing that he says will remake the U.S. trade order. It is difficult to see how imposed tariffs over time would not have some impact on prices, said Matt Blunt, president of the American Automotive Policy Council, which represents General Motors, Jeep parent Stellantis, and Ford Motor. An executive at one of the automakers said they were baffled by the desire to both impose tariffs and also tell car companies that they couldn't raise prices. The math would tell you that's going to cost us multi-billions of dollars, the executive said, so who pays for that? Unquote. All right, so I've got a lot of thoughts on this. A handful of points. Number one, we talked about this in our last episode, episode 22. Trump seems to believe that trade deficits are in and of themselves a bad thing, but that is simply not true. The fact that we buy more from a country than they buy from us does not mean that they're taking advantage of us. You take any country that's smaller than us, we have a really big market. We have a lot more consumers in the United States than they do, let's say, in Honduras, for example. So how could we possibly expect Hondurans to import more U.S. manufactured goods than Americans would import from Honduras? That just doesn't make sense. Point number two, Trump is conflating the tariff policy of other countries with our trade deficit with that country. Those are two completely different things. he's essentially punishing other countries for not buying more goods from us, which makes no sense for smaller, poorer countries. Point number 3, tariffs are essentially a tax on U.S. consumers. So the tariffs are paid by the importer, not by the country doing the exporting to us. So for example, if we put a tariff on goods from Ireland, for example, if a U.S. company, a U.S. manufacturer imports materials from Ireland in order to manufacture something, it is the company here in America doing the importing that pays that tariff, not Ireland, not the company in Ireland that's exporting the good that we're purchasing. Now, that is a tax that ends up being passed along to the end consumer in the form of higher prices. So it does have inflationary pressure. There's just no way around that. Now, it's also worth noting that it's unlikely President Trump even has the authority under the Constitution to impose such a broad set of tariffs without congressional approval. Trump is leaning really heavily on a very weak argument that trade deficits somehow create a national state of emergency. Congress traditionally holds the power of taxation, the power of tariffs. That's been semi-delegated to the executive branch when there is a cause for national security. So, for example, if there's a particular product that we really need to reshore and manufacture here in the United States for national security purposes, you could maybe make the case that semiconductors, we need to manufacture more of those here in the United States because those microchips are in everything from refrigerators to F-35s, right? The Patriot missile probably has microchips made in Taiwan. So you can make the case for maybe very specific things that you can impose the tariff to try and incentivize reshoring of manufacturing of something when it really has a national security implication. But to impose this broad of a set of tariffs on all these countries, on all kinds of goods, I have a hard time believing that you can make the case that we need to tariff coffee coming from Guatemala for national security reasons. So again, Trump is leaning on what I believe to be a very weak argument about how this creates a national state of emergency, economically speaking, in order for him to have the authority to do these tariffs. So that's going to be a challenge. Point number 4, the Trump administration is making 2 claims simultaneously. They're claiming that these tariffs will result in hundreds of billions of dollars in new revenue to the United States, which will somehow make our country richer. But they are also claiming that the tariffs will result in reshoring of American manufacturing jobs, which will help to boost our economy. However, both of these things can't be true. If you put the tariffs in place and consumers don't change their behavior at all, and then we continue importing these things from those other countries, then yes, we would get the revenue from the tariffs. However, if the tariff is there to incentivize us to manufacture things domestically rather than importing them, then we get the jobs, we get the manufacturing reshored, we get the growth in that particular sector of the economy at the expense of the rest of the economy due to the inflationary pressures of the prices being higher. So we would get the jobs, but we wouldn't necessarily get the revenue from the tariffs. It's an either or. You can't have your cake and eat it too. So I want to address this real quick. Trump has said that imposing all these tariffs is going to make our country much wealthier. I've got a chart here. This data comes from the World Bank. This shows very definitively that richer countries tend to have lower tariff rates. When you look at poor countries with a very low GDP per capita, they tend to have high tariff rates. On average, the more protectionist you are, the more tariffs you place on goods from other countries, that tends to lead to your country being less wealthy overall. The richer you are, typically the lower tariff rates you impose on imports from other countries. So this just makes me very, very nervous. If you've been paying attention, obviously you can tell I'm frustrated and I'm nervous. When Donald Trump was first elected back in November, we did a whole episode about his policy proposals and how a second Donald Trump administration was likely to impact the economy and the housing market. Go back and give that a listen if you're curious. Now, I've been giving Donald Trump a lot of the benefit of the doubt when it comes to his talk about tariffs. And that's because during his first administration, the actual tariff policy he implemented was a lot milder than the tariffs that he had talked about on the campaign trail the first time around. In his first administration, Donald Trump did a great job of using tariffs very strategically to extract concessions from specific countries. It was really more of a negotiating tool than anything else. Now, I've been giving Trump a lot of benefit of the doubt, and admittedly, I'm very, very nervous about these tariffs that he's rolling out, the impact they will have, but most importantly, I'm just really concerned about his methodology and his logic here. again, the fact that he came out into the Rose Garden with his chart saying these are the tariff rates these countries are charging on our goods when that just simply isn't true. The math formula they're using is they're looking at the trade deficit as a percentage of imports and they're calling that the tariff rate, but that's just not true. So we're going to see, of course, time will tell if we get some bad economic news, some bad headlines. Is Trump going to be too proud to roll some of these measures back? Maybe he's just looking for an excuse to be able to punch some holes in this and create exemptions. I believe we have already started to see some exemptions put in place onto this tariff policy. So time will tell how much of this sticks, for how long this stays in effect. But if all of these tariffs go into effect and stick long term, then my fear is that this will lead to renewed inflation and some negative economic news, which is not going to be good for the housing industry. But hey, I'm curious to know what you guys think about all these tariffs. Do you think they're going to stick? If so, for how long? What type of exemptions do you think we're going to see? How do you think these tariffs are going to impact the overall economy and the real estate market specifically? Feel free to shoot us an email, hello@realestatebackstage.com, or if you're watching on YouTube, drop a comment below and let's discuss. All right, y'all, that's a wrap for the show today. Thanks for watching. Thanks for listening. Just a reminder, you can find the show notes with links to all the articles and resources we referenced at realestatebackstage.com/episode 23. And I'll see you guys next week with another behind the scenes look at the real estate industry here on Real Estate Backstage.